How did Paytm, once a fintech titan, find itself in a downward spiral? It's a question that has been echoing in the corridors of the financial world. In a span of a few years, this giant that revolutionized digital payments is now grappling with a myriad of challenges. From regulatory scrutiny to a plummeting market value, the story of Paytm's rise and fall is a rollercoaster ride of ambition, innovation, and unforeseen hurdles. To understand this, we must first delve into Paytm's beginnings. Founded in 2010, Paytm quickly became a household name in India. This wasn't just another startup. This was a revolution in the making, a digital payments revolution that would change the way India transacted money. In its early years, Paytm was nothing more than a mobile recharge platform. But with a clear vision and relentless drive, it evolved into a comprehensive financial services platform. It ventured into areas such as mobile and DTH recharges, utility bill payments, movie and travel ticketing, and even online shopping. Paytm's rise was fueled by a unique blend of innovation, aggressive marketing, and a deep understanding of the Indian consumer. It was one of the first to embrace the concept of a mobile wallet, a move that resonified with millions of Indians who were eager to participate in the digital economy but lacked access to formal banking services. A key factor contributing to Paytm's success was its timing. The company hit its stride just as India was on the cusp of a digital revolution. In 2016, the Indian government's demonetization move, an attempt to curb black money, led to a sudden surge in demand for digital payment solutions. Paytm, with its easy-to-use platform and wide range of services, was perfectly positioned to seize this opportunity. Partnerships with major brands and retailers further boosted Paytm's popularity. It offered cashbacks and discounts appealing to the price-conscious Indian consumer. The company also tapped into India's vast rural market, introducing services like bank transfers and microloans. But it wasn't just about business strategy. Paytm's success was also a testament to the vision and leadership of its founder, Vijay Shekhar Sharma. His relentless pursuit of innovation and commitment to financial inclusion was instrumental in shaping Paytm's journey. But as the saying goes, what goes up must come down. Paytm's troubles began with the introduction of tighter regulations and increased competition. This marked the start of a challenging period that would test the resilience of this fintech giant. The regulatory landscape started to change dramatically. The Indian government, concerned about data privacy and financial security, began to tighten the reins. New rules were introduced that required fintech companies to store all user data within the country. This was a major shift that demanded a significant investment in infrastructure and data management strategies. For Paytm, a company that had flourished under the relatively relaxed regulatory environment of the past, this was a significant blow. Alongside these regulatory changes, the market was evolving. The fintech space, once dominated by Paytm, was now crowded with competitors. New players like Google Pay and PhonePe were making their presence felt, offering innovative services and luring away Paytm's customer base. They brought to the table deep pockets and an international perspective, adding to the pressure on Paytm. Key decisions also played a role in this story of decline. One such decision was Paytm's aggressive expansion into sectors like e-commerce and insurance. While diversification can be a successful strategy, in Paytm's case, it seemed to spread the company too thin. Resources were stretched, focus was lost, and the core business of digital payments began to suffer. Perhaps the most crucial event was the public backlash against Paytm's handling of user data. Allegations of data misuse and lack of transparency put a dent in the company's reputation. Trust, once lost, is hard to regain, and for a fintech company, trust is everything. As these factors combined, the cracks began to show. Paytm's user growth slowed, revenues dipped, and losses mounted. The company that had once been the shining star of India's fintech scene was now struggling to keep pace. But this was just the beginning of the fall. The worst, however, was yet to come for Paytm. As Paytm's fortunes dwindled, the company found itself under intense regulatory scrutiny. The Indian fintech giant, once a beacon of innovation and digital transformation, began to feel the heat of regulatory bodies. The Reserve Bank of India, the country's central banking institution, along with the Securities and Exchange Board of India, spearheaded this scrutiny. Paytm, like many of its peers in the fintech industry, was operating in a largely unregulated space. This lack of regulation was a double-edged sword. On one hand, it allowed for rapid innovation and growth. On the other, it left the door wide open for potential misuse and exploitation. The regulators' concerns were multifaceted. They ranged from issues of data security to concerns over anti-competitive practices to the potential for money laundering. Paytm was accused of lax data security measures, which could potentially expose millions of users to cyber threats. This was a significant blow to the company's reputation, shaking the trust of its user base. Then came the allegations of anti-competitive practices. Paytm was accused of using its dominant position in the market to stifle competition. These allegations led to a series of investigations, further tarnishing the company's image. The regulatory scrutiny had a cascading effect on Paytm's business. The company's growth began to slow, its stock price plunged, and investors became increasingly wary. The golden child of India's fintech sector was losing its sheen. This intense scrutiny also had broader implications. It served as a wake-up call for other players in the industry, prompting them to tighten their own regulatory compliance. It highlighted the need for a more robust regulatory framework for the fintech industry to ensure that innovation does not come at the cost of security and fair competition. The downfall of Paytm was a combination of internal missteps and external pressures. The regulatory scrutiny was the final nail in the coffin, cementing the company's fall from grace. Paytm was no longer the undisputed leader of India's fintech sector. Today, Paytm is a shadow of its former self. Once a titan of the fintech world, its current state is a stark contrast to its halcyon days. Financially, things are not looking too rosy. In the last fiscal year, the company reported a net loss in the billions. This is a far cry from the profit-making behemoth it was once known to be. In terms of market position, Paytm, which once led the digital payments sector in India, has seen its dominance significantly reduced. Today, it faces stiff competition from other players such as Google Pay and PhonePe, which have successfully chipped away at Paytm's market share. The company's ongoing struggles are manifold. Regulatory scrutiny, a key factor in its downfall, continues to cast a long shadow. The Reserve Bank of India's tighter regulations around digital payments have forced Paytm to re-evaluate its business model, leading to uncertainty and instability. Moreover, customer trust, once Paytm's biggest asset, has been severely impacted. The company's reputation has taken a hit due to a series of unfortunate events, including data breaches and allegations of fraud. Despite these challenges, Paytm continues to innovate, hoping to regain its lost ground. It is investing heavily in new areas like financial services and insurance, betting big on these sectors to drive its future growth. But the question remains, what does the future hold for Paytm? As the company grapples with its current predicaments, only time will tell if it can overcome its challenges and reclaim its former glory. Paytm's future is uncertain, but not entirely bleak. As we navigate the tumultuous currents of the fintech world, it's crucial to remember that change is the only constant. Paytm, despite its struggles, is no stranger to this truth. The company is undoubtedly at a crossroads, but it's equipped with the tools for recovery. Its expansive user base and diverse portfolio of services provide a solid foundation for a potential comeback. Paytm's plans for recovery are rooted in these strengths. By doubling down on its core competencies, like payments and financial services, and by innovating in new areas such as insurance and lending, Paytm hopes to regain lost ground. The company's strategy also includes a sharper focus on profitability. This could involve cutting back on cash-burning activities and instead investing in areas with high return potential. It's a delicate balance to strike, but a necessary one for the company's long-term survival. Yet the market is not without opportunities. The digital payment space in India is still growing at a breakneck pace, driven by increasing internet penetration and a shift towards cashless transactions. This could open up new avenues for Paytm to explore and potentially dominate. But the road ahead is not without challenges. Regulatory scrutiny continues to be a significant hurdle, and competition from deep-pocketed rivals is fiercer than ever. Success, therefore, will depend not just on strategy, but also on Paytm's ability to adapt in this rapidly evolving landscape. Only time will tell if Paytm can regain its former glory. In the meantime, it's a story worth watching, a story of resilience and reinvention in the face of adversity. As we watch Paytm's journey unfold, we're reminded of the incredible dynamism and potential of the fintech world. The future may be uncertain, but it's certainly not devoid of possibility.